I want to start with a question that might make you uncomfortable. What if the most dangerous moments in markets aren't when fear is loud, but when confidence feels calm, reasonable, and justified? Because history has taught me something over and over again. Major financial stress doesn't announce itself with chaos at first. It arrives quietly. It shows up as a signal most people dismiss, not because it's invisible, but because it's inconvenient. And today, that signal is flashing again. Most investors are ignoring it. They don't see it as urgent. They don't see it as threatening. But it's one of the first things I watch when markets are entering a fragile phase. And the reason I watch it is because I've seen what happens when it's ignored. Why calm markets are often the most dangerous. I've spent decades studying markets, not as a trader chasing short-term price moves, but as someone trying to understand how systems behave over time. What I've learned is this. Markets don't break when conditions are obviously bad. They break when conditions appear stable, even healthy, while stress builds underneath. Human beings are wired to extrapolate the recent past. If markets have been strong, we expect them to remain strong. If volatility has been low, we assume risk is low. But that assumption is one of the most costly mistakes investors make, because risk doesn't disappear when markets are calm. It concentrates, and that brings me to the signal investors are ignoring right now. The signal that whispers before it screams. The signal I'm talking about is the relationship between debt servicing costs and real economic capacity. That might sound abstract, but stay with me because it's one of the most reliable early warning indicators I've ever studied. Every economy runs on debt. Debt isn't inherently bad. In fact, it's necessary for growth. The problem arises when the cost of servicing that debt grows faster than the income and productivity supporting it. When that happens, the system becomes fragile, and fragility doesn't show up in prices immediately. It shows up in behavior. Why most investors miss this signal? Most investors focus on prices. Stocks, crypto, real estate, what's going up and what's going down. But prices are lagging indicators. They reflect what has already happened, not what's building underneath. Debt servicing pressure, on the other hand, is a leading indicator. It tells you when borrowers, governments, corporations, and households are quietly losing flexibility. And flexibility is everything. When flexibility disappears, systems snap instead of bend. But this signal is easy to ignore because markets still look strong. Earnings haven't collapsed. Headlines still sound optimistic. So investors assume everything is fine. History suggests otherwise. What this signal actually measures, at its core, this signal asks a simple question. How much of future income is already spoken for? When interest payments consume a growing share of cash flow, there's less room for error, less room for shocks, less room for adaptation. And when something unexpected happens, a slowdown, a policy shift, a geopolitical event, the system reacts violently, not because the event was catastrophic, but because the system was already tight. How this played out in the past. Let's look at history. Before the 2008 financial crisis, debt levels were high, but more importantly, debt servicing costs were rising relative to income. Households were stretched. Financial institutions were leveraged. The system had very little margin for error. The crisis didn't start when people felt afraid. It started when they felt confident. The same pattern appeared in the late 1990 seconds, and again in the 1970 seconds. Different assets, different narratives, same underlying mechanics. Today, I see many of the same ingredients. Debt levels are elevated across sectors, interest costs have risen sharply, and yet asset prices remain optimistic. That combination should always command respect, because optimism in the face of tightening financial conditions is not resilience. It's vulnerability. Institutional investors don't have the luxury of ignoring fragility. They don't ask what's going up, they ask what breaks first. They stress test portfolios, they think in probabilities, they reduce exposure not when panic hits, but when complacency peaks. That difference in mindset is why institutions survive cycles that devastate individual investors. What this signal is saying right now, I'm not saying a crash is guaranteed. I'm not predicting dates. What I am saying is that risk is rising quietly. And when risk rises quietly, it's often ignored until it's too late. That's why this signal matters. It doesn't scream, it whispers. What smart investors do when they see this, they don't panic, they prepare, they reduce leverage, they rebalance exposure, they ask uncomfortable questions. They stop assuming tomorrow will look like yesterday. And they remember that survival matters more than squeezing out the last bit of return. Here's the question I want to leave you with, and I genuinely want you to think about it. If markets remain calm, but the system underneath is tightening, what happens when the next shock arrives? Because history suggests it's not the shock that does the damage. It's the fragility that was already there. Markets don't punish optimism. They punish complacency. The most dangerous signals are the ones ignored during calm, and the most important moments aren't when fear is obvious. They're when confidence feels justified. Now I want to hear from you. Do you think today's markets are resilient or simply comfortable? And what signal do you think investors are ignoring right now? Leave your thoughts in the comments. I read them. If this helped you think differently about risk and cycles, like the video, subscribe to the channel, and share it with someone who still thinks this time is different.